Hi, I'm Jordan Bradford, Senior Financial Advisor and a Certified Financial Planner with the Tranel Financial Group. And today I want to talk a little bit about our portfolio models and the philosophy behind them. So it all starts with what's called the three-factor model approach. And this was actually a scientific research study done in the 90s at the University of Chicago. And what this study really uncovered was that there are three factors to investing that have bore out over time better than expected results. And this is based on size, value, and profitability. And so what this means, those are the three factors, is that small caps have a tendency to outperform large caps over extended periods of time. This doesn't mean that in any given 1 year or month or even a 5-year period that this is always going to bear out to be true. But it does show, if you look over time, that this yields a consistent result compared to owning just large cap stocks. And on the value side, we get a similar exposure to this with value stocks versus growth stocks. A lot of people think growth stocks are the way to go. They're the ones you want to buy when you're trying to achieve a really high rate of return. And while there may be some truth to this in recent years, again, if you look back over the last 50, 60, 70, even 100 years, there's a lot of statistical evidence to show that value stocks outperform growth stocks. And this is because of price. Value stocks are priced more attractively, meaning they have a lower price compared to what the market thinks that they should be priced at. So you're getting a discount. And that's really where the value comes in and why they are called value stocks. You're buying them at a discount. And the third factor, which is profitability, just states that companies that have high profitability levels tend to outperform companies that have lower profitability levels. And while this data doesn't go back as far as value or size, it does still go back all the way to the 1970s, which is a long period of time to have evidence to show that if you invest more money with high profitability companies, you'll achieve a better expected result than if you invest in companies that have lower profitability. And in our portfolio management strategy, what we look to do is to just tilt your portfolio towards those areas that we know have higher expected long-term returns. So you're not going all in on small caps and just going to own small companies or just going to own value stocks. But we want to tilt you in a way where more of your dollars are at work in those areas that we have evidence that shows that you will get a better rate of return or a better expected experience than if you just invested in large growth companies. So these are the three-factor approach that we have. And I think it's a great strategy for anyone to really utilize. And based whether you're a conservative, moderate, or aggressive investor, there are ways to add this approach into your portfolio in such a way where you can still be really conservative or you can still be really aggressive. And we can find a balance somewhere in the middle, which is where most people fall. They fall somewhere in the middle on this spectrum of conservative and aggressive for investments. And so applying this three-factor approach to your portfolio is a great way for you to start seeing a better experience in the market over time.